All right, we're here with Vassilios Rojendra, Senior Investment Analyst at Range. Vassilios, tell me what our members are talking about when it comes to the stock market volatility this past week.
Yeah, clients are definitely concerned. Obviously, it's pretty disconcerting to see markets go down, especially when we string together multiple days of down, somewhere between 4 and 5%. The important part and the thing that we continue to reiterate to them is that you really do need to stay invested. Here at Range, we really believe in having a long time horizon. And part of the biggest benefit you can have over a long time horizon is staying invested. And if anything, these opportunities that are presented when the market pulls back are opportunities to go in and look to invest a little bit more. So while people are concerned, and certainly we appreciate that, we really look to segment out. If you already have a good financial plan in place, you have the money set aside you need for short-term spending, for your medium-term spending and your long-term spending. And so specifically with those medium and long-term funds, we really want to make sure they are invested. And with the short-term funds, again, if you've planned it out, you kind of have those already in more conservative investments. And there have been safe havens. We've seen fixed income has held up fairly well. And so there are still sources of liquidity that you can tap. And that's the benefit of a diversified portfolio.
Tell me when you talk about short-term, medium-term, long-term, I imagine there's certain numbers, years that you're associating with what is a short-term versus medium-term, long-term. Tell me more about that to help me separate those.
So short-term can be anything, right? A known planned expense that you have, whether that's a college payment, maybe you're planning on buying a home, a new car, anything like that. Those short-term expenses, and when you have an idea of what you're looking for, you want to ensure that there's cash available. And this is no different than the way that a corporation would work when they're like, hey, we have bills payable in 3, 6, or 9 months. They ensure that they're going to guarantee to have cash available and they're not going to be beholden to market movements or anything like that. When you start looking at the medium term, yeah, these are the funds that, hey, I might want in 5 years from now. Maybe I'm planning 5, 6, 7 years from now to buy a new home, a larger home, a vacation home. Or maybe college is coming in a couple of years. Those are those kind of medium terms where it's not pressing and we want to make sure that we're invested. But the important part of identifying those are that way that we know 2, 3 years from now, we need to start getting a little bit more conservative with those funds. We're growing them while we can, and then over time, we glide path into a much more conservative allocation. And then when you consider the long-term funds, right, that's really where your wealth is created. These are the funds that I put it away and I don't want to see it and I don't need it for 10, 20, 30, 40 years. And the goal with those funds is to always keep them invested. Always keep them invested, always keep them growing. We say all the time, markets move up and to the right. And when you look at a stock chart over the last 150 years, over time, markets tend to go higher. And while there's certainly quite a lot of bumpiness along the way, the easiest way to ensure that you're taking advantage of that capital appreciation is to ensure that you remain fully invested, and especially in those long-term funds.
We've looked at some data recently that shows why it's so important to stay invested, especially when the market's going down, right? And some people might be surprised to better understand this. Can you tell me more about what the data shows there?
Yeah, the data's pretty stark, actually. And what you end up finding out is that when you miss the, call it 10% of days that are the highest up days, you actually wipe out almost all the benefits of being invested. Now, the tough part is nobody knows when those days are coming. And so, especially on the way down, it's very difficult to know where the bottom is going to be. And it's also difficult to know when the inflection will come and what the size or intensity of that inflection will be. And quite frankly, we've seen that even over the last couple weeks where there have been moments of time where there's been quite a bit of big turn in sentiment and we've seen pops. They've given themselves back, but we have seen that. And so the important part is if you're not invested, you're not taking part in any of that. But again, as we've said, over time, when markets are continuing to go higher, you want to ensure that you're staying invested. And in the long run, even if you're investing today, sure, the market might go down another 5, 10%. But when you're looking 20 years from now, you'd rather have been invested and taken all the capital appreciation than had your money out of the market and never gotten back in again. Because we say this all the time, but the hardest part when you take money out is to know when it goes back in.
And the most interesting thing for me has been that if you look back at history, even maybe just back to last 15 or 20 years, the best market days have come typically right after the worst market days. When you see big volatility that takes the market down, you tend to see really stark contrasts the next day, the next week or so, right?
Yeah, and when you think about it, you take a step back and think about it, it makes sense, right? In periods of high volatility, You have all the forces that work on the downside, so you get those 3, 4, 5% down days, are the same factors that can flip almost immediately to the upside. And so that's what you end up seeing, is that at any given point, there are always people looking to be invested, right? Long-term, most investors, they want to have their money in markets. They don't want to be sitting in cash. And so in the same way that on the downside, you see this momentum, people piling out, a lot of selling pressure on markets, it's very easy to see that flip in the other direction. And it's pretty commonly referred to as like a coiled spring, where people are looking for one or two pieces of good news. And whether that's the market starts to go up a little bit and everybody piles back in, or there's a good news headline, there's good economic data, whatever it may be, whatever that piece is, those forces that work to drive you down and dive you down very quickly can flip on a dime and shoot you back up.
What should, maybe if some of our members are watching this video, what can they do if they're kind of unsure about what to do and they maybe just want to reach out to the team and talk to them about all this market volatility?
Yeah, obviously we're here for you all the time. Please, at any given point, feel free to send us messages. We have an entire team here to speak with you, to talk about the markets. And it's important to remember, right, to keep a long-term time horizon. And when we think about keeping that long-term time horizon, we're okay with the day-to-day movements, because we know in the long run we're going to get paid off and we're going to be rewarded for staying investments. I know it's tough. We look at the markets every day, and we're talking about them all the time. And so certainly we're acutely aware of the pain, and especially when you see your accounts go lower. But the important part is to never be a fearful investor. It's an old adage, right? Be greedy when others are fearful. And time has proven for hundreds of years at this point, that's the opportunity for building your wealth. It's not pulling your money out. It's not getting overly conservative. It's sticking to your investment plan. And for every person, that's different. And that's part of what we do here at Range, is to each person, we customize not only our retirement planning, but also our investment recommendations to ensure that your plan is fit to you. And we have faith that as long as your plan is fit to you and we stay following that, we've already built that into our assumptions. We've built in volatility. We've built in the chance that you might have even 1, 2, 3, 4, 5 years of negative returns. And we're still delivering you in a retirement plan that works for you. And so from our perspective, it's just ensuring that we stay true to that plan, we keep you invested, and we're always here to talk through it at any point.
So if you're a Range member, go ahead and reach out to your team through inbox messages. If you're not a Range member and you're thinking, wow, I wish I really had a team on my side to help me guide through this market volatility. It's tough. We get it. Reach out to us. Head to range.com/learn to learn more about our investing strategies. We have a full team of people like Vassilios that can help you through all this market volatility. Vassilios, thanks so much for the time.
Thanks, Tony.